Gold, the biggest dip since last year. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, welcome back Sam, who's been taking a closer look at that pullback we've been experiencing after gold hit the new all-time highs recently. How are you going today, Sam?
Good, Chris. Good to see you.
Good to see you. Now, your article today, very interesting, really talked about gold having its biggest weekly dip since last year. Is that really setting us up for a rebound from here, or has it got further to fall? How are you looking at it?
A lot of it was from fundamental news releases in the recent weeks. So if it's going to rebound, look, it did pause. So it did take a pause and start to hook back up a little bit this morning. But overall, it was the biggest fall since late last year. It dropped 5%. That's over $120 USD in the gold USD price. So there was a bit of profit taking probably as well whenever it reaches up, obviously, to a new all-time high, which it did early last week. There are going to be some people cashing in profits as well. But that was just compounded by some of the Fed comments trying to convince people that they're not going to do as many hikes as they implied they would before.
And we've talked about this back and forth, this will they, won't they, how much will they do with the Fed? What are those recent policy statements saying? Are they leaning towards the one and done type scenario? Are we expecting a couple from them now? How are they trying to frame it?
Well, they're trying to frame it like they might just do one this year, and they keep mentioning the 2% inflation goal, although the market's kind of trying to call their bluff on that. And also people are calling to question why it has to be set in stone that they need to reach 2%. Is that, something that's going to magically fix, is it carved in stone somewhere that if we reach 2% going on their metrics, which they made up, everything's going to be fine. We're never going to have a recession. So who knows?
There's also been talk out of potentially China, and I know you've looked at that as well, this idea of Chinese retail demand for gold affecting the global gold prices. Would you consider that to be part of the further fundamental news around why it might potentially be a good buying opportunity for gold bulls? Because we've seen that price rising, and like I tend to look at it, even though it was a big pullback, it was a big pullback off a much larger move. So is that sort of normal there when you factor in some of those other fundamental factors?
Yeah, well, you're right. Chinese retail has been a powerful driver. Actually, retail everywhere in Asia has been a powerful driver, India as well. There are analysts speculating, though, that Chinese retail demand will dip in the second half of the year because it's quite obvious if you look at China's policies, they're really trying to reinflate the economy. We're still talking about hiking interest rates and keeping interest rates high and everything. They've been going quite crazy, creating money and trying to prop up the stock market and trying to convince Chinese retail to not just go and essentially hide and buy gold, but get back into the stock market. And they're trying to do everything they can, whether it's turning off short selling or doing huge stimulus for the building sector. So we'll see if that actually breaks the multi-thousand-year tradition, though, of Chinese retail gold buying. If they can actually do that, I'm not sure, but that's what they're trying to do.
That's so interesting too, because I hadn't really thought about it through that angle of obviously they don't want people hoarding their money away into gold, but the things you just mentioned where they're really printing all this excess money to try and stimulate the economy. The problem with that is, of course, it's liquid, it's liquidity, it leaks out into the rest of the world. And surely you would see the rest of the world jumping onto that as a buying opportunity to go, well, there's a whole lot of money printing going on in China. There's all that stimulus ultimately ends up in higher prices for gold. So do they end up in a sort of negative catch-22 situation there where they're not helping themselves because ultimately the rest of the world jumps in on board that trend?
It is. It's completely ironic. I mean, we've been covering the liquidity increase here, and that's stimulated some Western buyers to jump in big on gold because they say, oh, look what China's doing. The rest of the central banks will follow eventually, or look at global liquidity increasing, that's a reason for me to buy gold. So it is quite ironic. They're essentially saying, don't buy gold because we're going to print a lot of money. Well, that's one of the only reasons to buy gold. So
And I suppose then it just comes down to the lag effect of how long that takes to filter through. But these days, it seems like, if anything, the gold market's trying to front run a little bit of that.
yeah, so jump in on the stock market jump this week and miss out next week, or get in on gold and miss out on the stock market this week and see gold go up next week. It seems like the kind of catch-22 you're talking about.
So if we sort of think of it from the investor perspective, that they're looking at gold as a long-term investment, so not trying to do that short-term jump in and out.
Mhm.
What do you think or what would you recommend as strategies that potentially would allow someone to capitalize on these current market conditions? Because there is that fluctuation going on. It feels like it's a bit of a tug of war for the things you've described from, depending on which country you're looking at. What's the approach that you can think might be best for an individual who's trying to take advantage of this?
Well, for someone who thinks that gold will continuously rise, obviously, if someone thinks gold is a bad investment, then they shouldn't buy any. Seeing that someone does think that gold is a good investment and hedge against inevitable inflation, then there are a couple strategies. One could be the dollar cost averaging, just buying X amount every week or every month. And then the other one is actually just hunting dips, having a bit of reverse psychology and not seeing every time the price rockets, jumping in and buying more expensive gold, but looking for an actual dip in the market. For example, a 5% dip just happened based off some speakers that came out and essentially scared the gold market down and boosted the stock market up a little bit. Then again, we have coming out Friday at 10:30 p.m. we have some inflation data. So this is the Fed's preferred inflation metric is going to be coming out, and that's core personal consumption expenditures. So that'll be Friday, Melbourne, Sydney time at 10:30 p.m. And if that is, whether the number is bigger or smaller than expected, it could make the gold price go up or down. And in that situation, it's really just trying to find an opportunity for a big dip to happen, like the one that just happened, and then putting in X amount of risk capital to take advantage of that.
And I really like the point you've made. We just did have one of those big dips. Everyone likes to think that they are a dollar cost averager. Everyone likes to think that, yeah, I buy the dips. But when they actually happen, a lot of people get scared away. And you've just pointed out a couple of times there, we just had one of those dips. So if you're true to that strategy, then this is the time where you accumulate a little bit more, isn't it?
Yeah, it's not really dollar cost averaging if you're only buying the peaks. That's
Well, it's
that's
a
called
form of dollar cost averaging, but not the optimal one.
well, it's called FOMO. I mean, if someone happens to dollar cost average every time the price goes dramatically upward, they're either the unluckiest dollar cost averager in the world, or they're not actually dollar cost averaging. They're just experiencing fear of missing out, which is what people should try not to do.
Sometimes easier said than done, but it really a sound strategy there, I think, to just, take some of that volatility, short-term noise out of the picture and just look for opportunities like the ones that we've potentially just been given. Well, lots of valuable insight in there today. Thank you for that, Sam.
Thanks, Chris.
Thanks everyone for watching. We'll chat again soon.